The figure on the screen is the fraud triangle. These three factors must be present for a person to be able to commit fraud. The three things that are in the fraud triangle are opportunity, pressure, and rationalization. So rationalization is where the person who's about to commit fraud talks themselves into making it okay. For example, maybe they are unhappy at work. Maybe they feel that they aren't paid as well as they should be paid, and so they will use that as rationalization to commit fraud. The company owes me money. They should be paying me more money. I deserve this. It's okay. Okay. Pressure is an outside pressure to commit fraud. Examples include being highly in debt, having a bunch of unpaid bills, medical debt, any financial debt. This is often the case when you ask people why they've committed fraud. Often it's because they had medical debt, medical expenses, or sometimes they just like the money and like having extravagant lifestyles and a lot of money to spend. And then the third component of the fraud triangle is opportunity. A person cannot commit fraud unless they have access to the finances of the company. So you have to have access or opportunity. You have to have access to the company checkbook or the company accounting records in a way that you can make changes to them and people aren't going to question those changes. As I said, all three have to be available. The only thing that a company can prevent is opportunity. Okay, rationalization and pressure come from the individual. Ethics training can help to guarantee that an individual won't commit fraud at some point, but the opportunity is where the company is required to put rules and regulations in place that do not give anyone open access to the accounting records in a way that they can do whatever they want and someone wouldn't eventually catch it. Generally accepted accounting principles, or GAAP as they're called, and sometimes it's called US GAAP because these accounting principles are unique to the United States and companies operating in the United States. International accounting has its own rules and regulations outside of US GAAP. US GAAP are the financial accounting rules, managerial accounting rules that have to be followed for the creation of financial information and accounting information. Okay, they can change over time. So GAAP laws are put into place in a variety of ways. They can be created by Congress. They can be created by the Financial Accounting Standards Board. And how they get implemented depends on different laws and regulations that take place, ways to prevent fraud. If some company has committed fraud, from finding a loophole, then a new rule is written to remove that loophole, or some various ways. Okay, so we have all of these standard setting groups. So the first is FASB, which is the Financial Accounting Standards Board. They are tasked with managing and creating GAAP standards. So this is an accounting group that maintains the GAAP library and makes sure that accountants follow the GAAP library and have access to it. They also are in charge of creating new GAAP standards. Okay, then we also have the Government Accounting Standards Boards, and they are in charge of government accounting, generally accepted standards. So that's what GAGAS is Government Accounting Generally Accepted Standards. This is a equivalent of GAAP standards for government accountants. Okay. IASB, or the International Accounting Standards Boards, they create IFRS standards. IFRS stands for International Financial Reporting Standards, and these are the standards that are for international accounting. The Securities and Exchange Commission, or the SEC, is a government agency created by Congress that oversees GAAP and financial reporting for any company who sells stock to the public. So these are companies that trade openly on the New York Stock Exchange, and you can buy shares of stock. Okay. The Public Company Accounting Oversight Board, or PCAOB, sets auditing standards for publicly traded companies. So they create audit standards. And then Congress, U.S. Congress, creates accounting policies by passing laws and regulations. For example, Congress created the SEC, or the Securities and Exchange Commissions, and they direct what the SEC can and cannot do. They also give new rules and can create new GAAP laws. Okay. Then we have professional organizations for accounting, and this is just a sample of professional organizations for accounting. Every single type of accounting specialty has its own organization. For example, one that I don't see up here is the AGA, which is the American Government or Government Accounting Association. So that's another one. So we have the AICPA, which is the American Institute of CPAs. This is financial accounting. Then we have the Institute of Management Accountants for managerial accounting, Institute of Internal Auditors. There are also financial audits. There's fraud accounting groups. The American Accounting Association focuses on accounting education and is an organization for professors and educators to join. COSO is also an audit group, and they are in charge of external audits that companies have. Okay, I'm going to talk about some principles, assumptions, and constraints, and these are really the rules that we have to follow and when we're doing accounting. So we have specific principles, which are detailed rules, general principles, which are the guidelines for preparing financial statements. These all fall underneath GAAP, and we're going to talk about each one of them. Some of the highlighted ones that we're going to be encountering during this semester that we would be required to follow as part of the information that we're looking at. Okay, so one is the measurement principle, which is often called the cost principle or the historic cost principle. And what this rule states is that accounting information is based on actual cost, because the actual cost is considered objective. And it's because you have receipts or legal documents for what you actually paid for something. A good example of how the measurement principle works in practice is if we bought a piece of real estate. So often real estate has two different values. They have the market value, or what it demands in the marketplace for cost, and then you have the assessed value. In our accounting records, we have to record that as the exact price that we paid for it. And that's how it stays on our accounting records until we dispose of it, regardless of whether or not its market value changes. Because the only record that we have that is a legal document is the check we paid, that we have to record it at that amount. Okay, the revenue recognition principle, and this is one we're going to talk about a lot, especially, and the expense recognition principle. Okay, so this is that companies can only recognize revenue when goods and services are provided to the customers and they are expected to be paid for those goods and services. So both we expect to receive money and we've completed the by giving the customer the goods or the services. Okay. This expense recognition principle, which is sometimes called the matching principle, says that we have to record expenses to generate revenue reported. So this means that if we have generated revenue in accounting period, we need to record the appropriate expenses with that time. Okay? And then the full disclosure principle. What the full disclosure principle really says is that if any information would impact a user's decision about our financial records or the financial health of the company, we have to provide that information. Okay, so now we have our different assumptions that we're going to be looking at. So one is the going concern assumption. This assumption is just the belief that the company is going to continue forever. Our monetary unit assumption assumes that all transactions and events are expressed in monetary units. In the US, we use the dollar. In Europe, they use the euro. In the UK, the monetary unit is the pound. If you are an international company, you have to convert everything into one single monetary unit. So for example, if you're a company who's trading on the New York Stock Exchange and you're doing SEC reports, you would translate all of your transactions into the US dollar before you reported them. The time period assumption states that accounting information and the life of the company can be divided into time periods. Every month, every year, every quarter. These are the most common time periods that accounting information gets divided into. And then business entity assumptions. So this assumption states that a business is separate from other businesses and including its owner. So we keep the financial information about the business completely separate from other businesses we might own and completely separate from the owner's financial information. Okay, now the constraints. We're also going to be talking about these 3 constraints this semester and how they impact different accounting practices. The cost-benefit constraint. So only information with benefits of disclosure greater than the cost need to be disclosed. This means that we should try to provide all of the information that we possibly can, but sometimes collecting certain types of information cost more than the benefit of having that information is. In this case, you don't have to maintain that information. We're going to have a really good discussion about cost-benefit constraint during weeks 2 and 3, and specifically how they impact some managerial accounting information. Okay, materiality constraint. So this is only information that would influence the decisions of a reasonable person need to be disclosed. Okay, what materiality looks at is the information material or not? And usually what decides if it's material or amount is the amount of information that we're talking about. And companies decide this. For some companies, $100 is a material amount. And for other companies that do billions of dollars in revenue, $100 would not be considered a material amount. We're also going to have some very good examples of this semester when we talk about the various accounting treatment for overhead and cost of goods sold. Okay. Conservatism and industry practices are sometimes also included as constraints. Conservatism is being financially conservative, not carrying a lot of debt, not taking a lot of risk. Various industry practices would be what is popular for financial decisions in this industry. We're going to talk more about industry practices really in chapter 16 when we talk about financial statement analysis. Okay, in the next video, we're going to start off by talking about different types of businesses.